Good afternoon, everybody, and welcome to another MECLA Spotlight event. We're delighted to be co-hosting it with the Investor Group on Climate Change. And today's topic is the role of investors in measuring and achieving lower embodied carbon in real estate and infrastructure. And delighted to be with you today. Before I start, I'd like to acknowledge that we are all on Indigenous land all of the time. Today, I am coming to you from the Yuwi Burra people up in Mackay, and acknowledge elders past and present, and please acknowledge all elders past and present, all the places that you're coming from today. So we've got a really exciting lineup of people today. Just a reminder that MECLA operates under a pre-competitive environment, so that is very clearly stated in our governance arrangements, and we are delighted to be introducing to you the panel today. But first of all, I'm going to hand over to Rick Walters, who wears a number of hats as a participant in MECLA, but also as part of the Investor Group on Climate Change. And before I begin, we do have a Menti. Please join the Menti. That will help us to provide some input and feedback on what are the particular issues around embodied carbon that either you do or don't understand, have questions on, that can help us to sort of craft the next pieces of work for us. But on that note, I'd like to hand over to Rick Walters. Thank you, Rick.
Thanks very much, Monica. It's fabulous to be here today with everybody. I am wearing a few hats. So firstly, I'm a Senior Manager Responsible Ownership at Aware Super. I work very closely with all of our real assets in property and infrastructure, so very pertinent to the discussion today. But I also wear a couple of other hats, and I've been involved with both MECLA and IGCC for a while. With MECLA, I've been on the project control group and also working with the demand side working group, which is looking at how to ensure there's demand for embodied carbon in the industry, and investors are part of that, which we'll talk a bit more about today. And with IGCC, I've been co-chairing real assets working group, where we've been looking at a whole manner of things around climate, both on the mitigation and adaptation side. And when this opportunity came up to sort of join the dots and join the sort of real economy and investor worlds together around embodied carbon, it seemed like a great opportunity and something that both organisations and the industry could benefit from. So really pleased to see this coming together in the form of this guide and this webinar today. Bit more about the guide then. We'll get into it as part of the presentation, but just as a scene setting, MECLA has been working with the industry and particularly with governments as being often the instigators of demand for embodied carbon reductions and improvements and so on, and measurement. And that has been very successful, and a lot of Australian state and federal governments are on board and promoting the benefits of addressing embodied carbon. But private sector, in terms of the demand side, has probably been a little behind government in some respects. Investors can have a key role in generating and demonstrating that demand for embodied carbon practices. And that's, again, what we were hoping to do through this guide, is to talk about that, explain that role and how it can work. So being a Scope 3 emission, embodied carbon is a bit more down the value chain for investors, and that's something that will come through in the guide and in what we talk about today. So we will have a bit of a background on the guide, a bit of an introduction from a few people, and then we'll get into a panel discussion at the end with some fantastic panelists who we'll introduce shortly. But my next step is to hand over to Duncan Patterson from IGCC to talk about their role. Duncan, over to you.
Thank you very much, Rick. Pleasure to be here today. My name is Duncan Patterson. I'm the Director of Investor Practice for the Investor Group on Climate Change. I come in today from Sydney, where the traditional owners are the Gadigal people of the Eora Nation, and we acknowledge their elders past, present and emerging, and their ongoing connections with the land that we live, work and play on. Just as general background, Investor Group on Climate Change is an organisation which represents institutional investors and participants in the investment supply chain across the market in Australia broadly. Our members manage just under 5 trillion of locally managed investments on behalf of New Zealand and Australian investors, and 40 trillion investments globally across our membership. At this point, I want to acknowledge the great work of Rick. Thank you for the efforts that you've put into bringing the perspective of IGCC's investor practice sub-working group on the topic of real assets into this discussion. I know that the members of the sub-working group really appreciated the chance to provide feedback on the initial drafts of this work. I'd also note here the important role played by my colleague Marwa Curran, who acts as the secretariat for this sub-working group. So this is an area that investors are very interested in, and the fact that we have a focus area on real assets is an illustration of that. Just as a bit of general background, IGCC has recently released our annual State of Net Zero report, and a couple of key findings to pull out of that which are relevant to this conversation, and why investors are starting to pay more attention to embodied carbon. So firstly, board level climate governance has really strengthened in the most recent findings. So 2/3 of asset owners now have formal climate responsibilities in their board charters, and boards are requesting financial metrics and asking whether capital expenditure aligns with their overall organisational transition plans. And this does matter for the topic of embodied carbon, when boards ask whether a property or infrastructure asset is genuinely transition aligned. Operational carbon alone is no longer going to answer that question. We're also seeing that investors on their engagement and stewardship activities are broadening it beyond the traditional work they're doing in equities and looking at individual assets now, and also value chains and using supply chain thinking. And that's exactly where embodied carbon sits. Using systems thinking in that supply chain of materials, construction and development. Some of our data shows that green property is among the top climate solutions investors want exposure to, and this appetite increases year on year. But at the same time, we're seeing a lot of investors saying that there's a shortage of opportunities with appropriate risk return profiles for them. So the demand is there. It's just challenging to make sure that investable pipeline is keeping pace with the interest that investors have in this topic. And that could be for any number of reasons, not just returns. It's also things like regulation, investment structures and things like that. So we're doing a lot of work in this area. A significant part of this gap, though, is measurement. Investors aren't able to price what they can't see, and embodied carbon has largely been invisible in the information they receive from developers and asset managers to date. So we're keen to see this work advance. Investors are increasingly willing to use voting and engagement where capital expenditure doesn't align with stated transition plans, but they really need that underlying data to make that case. This is a really important area of work. The paper we're launching today matters because it starts to make embodied carbon legible to capital markets, giving investors a framework to ask the right questions of developers, asset managers, and the assets themselves. Because capital is a critical player in the project supply chain, and investors are therefore very important part of the system that will ultimately drive action on embodied carbon. If anyone is interested in this work, I've got the slide up there. Thank you for sharing to our friends at MECLA. Please look at coming along to our summit in November. We're collaborating again with MECLA on a panel session on the topic of embodied carbon, which will hopefully help to take the conversation another step further and raise the profile with the investment community. Thanks again for your time. It's been great working with you guys on this project, and I'll hand back to, I think, Kathy, and look forward to listening in on today's proceedings.
I guess what's really interesting about the evolution of this work in the real economy, if you think about the Science-Based Target Initiative and the Paris Agreement, we were talking about Scope 1 and Scope 2 emissions before that time, alignment to a 1.5 degree pathway, but the embodied carbon is really part of the Scope 3 emissions, those indirect emissions. And if we go to the next slide, you can see that really when we're talking about the whole of that picture around embodied carbon, the majority of the emissions and the majority of the decisions are the upfront carbon. So that's the raw material mining, manufacturing, transporting, and then into the building and construction part. So that's the A1 to A5. And then obviously for decisions around the end of life and use of existing assets and what you do with that. So the decisions that are made about the procurement of the steel, the concrete, aluminium, or whether you use timber or other materials are made right at the beginning at that upfront carbon. And that's the critical decision-making point. And I guess that's part of how investors can influence some of those decisions for the investment that they invest in, as well as the end of life, how you best utilize the asset at the end of life and how you value the materials that have already been manufactured. And of course, there's a circularity piece to that as well, that cradle to cradle. Just the next slide, please. So, many of you will be familiar with this schema that really, again, it comes back to that decision-making process. So, the decisions to build or not to build is a really good question. Or how do you build less? Or how do you think about building within a carbon budget, for example? That's something that UK highways have been doing very well. I think we've had a few projects where some of those decisions are made very well that have the biggest impact. And I guess as investors, where you're thinking about what your transition risks are and some of the decisions about how you finance and think about financing these assets, these kinds of questions are probably starting to appear in the conversations that you're having there. So this, some of you will be familiar with, some of you not. This was the original piece of, I guess, intellectual property when we developed MECLA, thinking about how do you invest, how do you intervene across the system in a very complex built environment. And so right at the top of that chart is the construction project lifeline, and you can see that all of the majority of those points are all about the design and the decision making that goes into the design and the construction, what kind of materials you use, the kinds of construction decisions that you make over that time. But clearly in that lighter green below, financial institutions also have a part to play in determining what kinds of design decisions. So, the policies that are put in place, and I guess now you've got the mandatory reporting requirements for scopes 1 to scopes 3 is going to be fundamental to some of that decision making and how you think about the finance risk versus reward there. And one more slide, maybe. So this, I think, is a really interesting slide also, because the Green Building Council did some work with ThinkStep, ANZ a few years ago, looking at what the scope of the built environment, embodied emissions versus operational emissions is, and comparing it to be business as usual in 2050. And you can see in 2019 that the vast majority of the emissions are in the operational emissions. But as we decarbonise the built environment, electrify buildings, we go from it being the majority of emissions to it being a very small minority of emissions, and therefore the embodied carbon becomes the vast majority of those emissions there, and 85% of the problem to be solved over time. And we can talk a little bit more about that and how various people on the panel are thinking about it in terms of their businesses and the real economy. So Rick, I think that's it. I'm going to hand back to you.
Great, thanks, Monica. And here we have the guide. So right on cue. Please download that if you haven't already seen that. It really is a starting point in a way for the discussion between investors and the rest of the industry around embodied carbon. I'm sure there's sort of further things we'll probably seek to add over time, and we definitely welcome feedback on that as well. But we're very proud that we've been able to put something out that it does build on other work that's been done, some of which has already been mentioned today from Green Building Council and others. But we think it does take a step further in terms of starting to really clarify the role for investors around embodied carbon. Next slide, please. So this slide is a little bit similar to Monica's, but what I've done here is taken the building data and added in the infra data as well, made a few assumptions, but you can see the same sort of effect happening here that in today, let's say, based on 2019 data, the vast majority of emissions are from operational emissions for both buildings and infrastructure, but those emissions are rapidly decarbonising as the grid electrifies, as buildings electrify, as the grid decarbonises, as buildings electrify, as infrastructure electrifies, and so on, so that we get to a state, if nothing else changes with embodied carbon, where it's loaded up with embodied carbon by 2050, as Monica pointed out. And so if we don't start to address that embodied carbon sooner rather than later, it's a real material issue for the real economy. It's going to be a huge part of Australia's footprint, as buildings and infrastructure is now, but we won't have done enough to get those industries, I guess, to net zero. So why is it material to the real economy? I've outlaid some part of the case there. That first point. The second point, I guess, is that the project timeframes are quite long for real assets. So you're talking about decisions made now that might take 2 to 7 years to come into play in terms of the construction and ultimately then operation of assets. Those assets might last 30 to 100 years, is quite normal, and they're the sort of design lives that we're talking about. So those decisions we're making today are locking in emissions for many decades. And so if we don't start addressing embodied carbon, those emissions won't start coming down. We'll end up in that BAU. And the last point being that often these emissions are related to industries that are hard to abate currently. And that's why I guess, the other operational emissions are expected to come down. But if we don't do anything, these emissions will remain high because they're often in hard to abate industries like cement making, concrete, like steel making and others. These aren't things that necessarily there's all the right solutions right now that can just be turned on with very simple procurement decisions. There's some complexity to it. There's opportunities to do things, but it's not simple decisions, and it's not always the cheapest decision. So there's a lot of challenges to that. And again, this is where procurement decisions by the developers, by leaders in infrastructure and real estate can make a big difference and need to start to make a big difference. So a key reason it's material for investors then is that, well, it's material for the real economy, so what? But for investors as well, with mandatory reporting, there's a requirement to report on our investor scope 1 and 2 emissions, but also on material scope 3 emissions. And for investors, scope 3 emissions include the investments that were made. They're a category of scope 3 emissions. And within that, then, you've got all the complexity of the real economy of what makes up those various emissions. And a portion of those scope 3 emissions is obviously the scope 1 and 2 for the companies we invest in and the real assets we invest in, but also the scope 3. So those scope 3 emissions for companies and assets we invest in can be a significant part of our scope 3 emissions as investors, and they are mandatory to report on within certain timeframes for the Australian mandatory reporting and other jurisdictions as well. So that's one reason. It's also strategically important as the world decarbonises and as people act on climate change. Addressing those emissions becomes a real climate risk, and as things might occur, like a carbon price, as the economy changes and decarbonises, then they present a real risk that you're left with stranded assets if you're not doing enough to address embodied carbon. And that's the second sort of key reason. And then just the advantage that you gain from being in front of this. So there's a whole bunch of reasons there, which we'll explore a little bit more around the whys. But hopefully that gives you a bit of a flavour for why it's material for the investor, why investors need to act, and why real economy actors need to act. And I guess that's why we've come together with this guide. Addressing embodied carbon is not a straightforward issue, and it really does require teamwork within the industry. And MECLA's seen that across a whole bunch of different parts of the value chain around embodied carbon. And this part of the value chain around investors, developers, constructors, and so on is really only going to be consequential if the different parties can work together. If the demand is there from investors asking around embodied carbon and for reductions, and if the developers, contractors, so on, are then responding to that demand and being able to deliver. But it's not going to take one party on their own, will not be able to do it. So it's a real team effort. And with that, I'll hand over to Daryl Stuckey from Lendlease, who's going to give us a little bit of discussion about how do you do it as an actor in the real economy. And Daryl will also be joining us shortly on the panel, but I'll come back and finish off with a little bit more on the guide before that. Over to you, Daryl.
Thank you very much, Rick, and hello, everyone. Yeah, look, firstly, I'd really like to acknowledge the work that IGCC, Rick, and MECLA have done here. I think it's a great step forward, and I think it really starts to reinforce what we see as a very important thing, which is about bringing that shared sense of responsibility across the entire value chain. And I think, obviously, bringing capital finance to the table as part of that is certainly very important. For Lendlease, we've set a clear ambition around our absolute zero by 2040. It's a very ambitious target and is focused around scope 3 as well as our scope 1 and 2 emissions without offsets. And embodied carbon, as Rick's just alluded to, and Monica as well in her presentation, is a significant component and only becoming more so in time. So for us, embodied carbon is a large part of our scope 3, which we really are focused in on. I think for us, we have been working on this for well over a decade. There's still a lot more to do, but we have come a long way. And I think the time is sort of now. We have a lot more rigor in the measurement, enough rigor in the measurement, I should say, to start to enable better connecting and helping people to price what has previously been unable to be priced because it lacked the visibility. So if I just, in terms of the slide, there's really kind of 3 key areas. So being able to measure and benchmark is certainly really important. For us, like I said, we have cut our teeth on a number of buildings over many years, and that helped us to establish some benchmarks. But I think, organisations like Neighbours with embodied carbon benchmarking, the work that Green Star and Green Building Council have done as well is really helping to start to better define what those benchmarks are now. And we have established our own internal tool based on our own historic data across a number of different assets in different markets as well, given that we are developing here locally, but also offshore. We use those benchmarks and then use it to set what is a meaningful absolute zero target for a project. So the Lendlease Embodied Carbon Advisor tool is what we have developed to do that, and we do that at the earliest stage of a project. So we have an investment decision process, which is effectively where we're making the earliest decision on a project. At that point, we set the target, and that target is set, again, based on that benchmark data, but also the delivery time frame of the project. So when are we actually going to be procuring trades to deliver the project on site? And also, where does that map in terms of the science and our absolute zero target? So the further out and closer you get to the 2040 for us, that raises the level of ambition and expectation on the project. And so in setting, I guess, that target, it helps put the flag on the hill and make it meaningful to an individual project. And I think, obviously the work with the guide really speaks to the fact that we need to start to then also connect the financing. So I think, we don't deliver buildings in isolation. We obviously deliver them on behalf of customers and investors in many cases. So it's how do we then get alignment around those targets with our investor community, and then we can start to work through, what does that target look like, and how do we deliver it. So again, in terms of achieving reductions, for us, the advisor tool takes things a slight step forward in terms of then articulating what would the material specifications need to be for some of the key products. So Rick mentioned earlier some of the hard to abate materials and components that typically go into buildings, such as concrete, reinforcing steel, structural steel, the cement component in concrete. These elements, we can start to then drive a specification in terms of what is the emissions performance that we would need to specify in order to meet the level of ambition at the building level. It also starts to indicate, where are there opportunities for us to start to also need to push into design considerations. So how do we start to value engineer what we're delivering? How do we get smarter with the mix of components, products that we're using to build? Or are there sort of repurposing opportunities as well if we are looking at an opportunity where there's an existing building that we're repositioning? So I think that's probably enough for now. Rick, we can probably cover off on a bit more in the panel discussion.
Thanks, Daryl. That's fantastic. Someone has also asked a question about mandatory reporting. So I think this diagram really lays it out beautifully, in that investors have scope 1, 2, and 3 emissions. In our scope 3, there's 15 categories, and the most significant one of those is nearly always category 15, which is the emissions associated with our investments. So not our own in our offices and our activities, but the ones associated with the activities of our investments, the companies and assets that we own. So within those, they're made up of their own. If you look at the investee company at the bottom, they're made up of their own scope 1, 2, and their material scope 3. And the embodied carbon is within that set of scope 3. So for real estate, that can include tenant emissions for those buildings where there are tenants, but also very significantly, it can include, especially where there's development, embodied carbon emissions. And that's where it'll flow through into investors' requirements. So if that component is significant enough, is material enough, then that is required in the mandatory reporting in the second year for super funds, for example, of reporting. The strategic benefits just noted there worth pointing out is it can affect project costs, especially if there's carbon pricing. It can affect things like asset valuation. So sometimes there can be real value exhibited in terms of green premiums for good quality projects, and sometimes brown discounts for high intensity carbon projects. And then addressing that long-term transition risk that I mentioned as well. And the other thing before we leave this slide is, it's a key part of achieving alignment with net zero targets, like at investor level, the NZIF framework is very good. At company level, things like Science-Based Targets Initiative, and at building level, some of the rating tools require a measurement and reduction of embodied carbon. Next slide. Okay, and next slide. Okay, for the guide, we've broken the very complicated investor world into sort of 3 chunks of types of investment and capital structures to make it a bit easy to understand how investors can influence embodied carbon outcomes depending on how they invest. So briefly, in terms of this diagram, we've got on the top right, private unlisted equity ownership. So this is something where super does a lot of direct asset ownership, directly buying infrastructure and property companies and assets. And sometimes investors will do it through unlisted funds, private funds. So they'll work with a manager, invest in their fund, and own a bunch of assets through that fund. So that's one form of investing. It tends to be, as you can see, a high degree of influence because you've got a high degree of ownership of those assets. And it tends to be a bit higher in the risk return profile as well. Then at the top left, we've got listed equities or public listed equities. And they are things like listed REITs and listed infrastructure equities. So that's where you own, but through a stock exchange or similar, and tends to be a much lower degree of influence because of much lower share of those companies that any one investor might own. And the investors are unlikely to have things like board seats and so on. So it's a much smaller fraction that you own, much different sort of level of influence, and therefore that influences how to address embodied carbon in those assets or companies. In the bottom part of the diagram, we've bundled into a big block called debt or lending, and there's sort of two main types of that: public bonds, which are sort of listed debt vehicles on stock exchanges and the like, where anybody can come along as a retail investor or so on and buy those bonds. And then the more specialized private loans, mortgages, and debt funds, which is direct loans to assets and companies in the form of those sorts of structures of loans, mortgages, and so on. So more influence on those private side and a little less influence on the public side, because the issuer on the public side is just going out and saying, who wants to buy these bonds, and waiting for people to buy them up. And they could be, again, of all types, retail, wholesale, and so on. On the right-hand side, it's a direct relationship between the lender and their borrower, and they can agree terms and so on. So we'll talk a bit more about, again, how that influences the way to drive embodied carbon outcomes. Next slide. So with private unlisted equity, I'm not going to go through the table on the left, but you can see that there's a whole range of points during the life cycle of real estate and infrastructure where embodied carbon can be addressed, right in the early planning and design, right through all of the various stages, construction, and into handover to operation. There's all kinds of things that a developer can do and an investor can do to address embodied carbon right through, often doing things like embedding requirements around rating tools, asking for particular practices, and so on. And because of that high degree of influence for this type of investment, there's a great opportunity to be involved early, set the scene for how things should be done, start to require embodied carbon to be measured, start to require embodied carbon targets to be set, and start to actually ask to see how that will be done. So that's really, I guess, the point of that private unlisted equity. That's something that we can do, and we'll talk a bit more about examples of that on the panel in a moment. The next slide. When it comes to public listed equity, as I said, it's a lesser ownership, less influence. So what the guide does is encourage engagement with the parts of the value chain and a sort of more of a systems approach. So that could be working with listed companies, like Lendlease is a good example. Lendlease is listed on the Australian Stock Exchange. So investors in Lendlease can meet with their managers, meet with their representatives, and talk to them about what they're doing around embodied carbon. What do they like about it? What do they not like about it? What would they like to see more of? And so on. So it's an engagement approach, but it's not because the influence is lower, it's not like you can come in and direct that they do X, Y, Z, which is a little bit more the case with private investment. They can also target the supply side of the value chain, such as things like steel makers, like a BlueScope is listed, for example, and look to influence their practices and how they're reducing their emissions, which are supplying into the value chain for embodied carbon into buildings and infrastructure. Next slide. And then lastly, on the debt side, debt investors, including banks, can have a high degree of influence because they're dangling the carrot of a loan. But it's typically only at that point when the loan is negotiated. So it's, with a loan, as you know, with your own, say, house mortgage, once you lock those terms in and it's agreed, that's it. It's very rare to renegotiate those unless something comes up to maturity. But again, that is a point where things can be locked in, where agreements can be made about what is going to happen. And so that is the time when actions to address embodied carbon can be discussed and agreed. And so things like a sustainably linked loan, which is an example of a type of loan which brings in KPIs around sustainability, can have things like requirements for regular reporting on embodied carbon performance. It can trigger review events. So if embodied carbon is, say, not on target or not being measured, not being reported, that can be trigger a review of the loan and some changes to be made. And then ultimately, at its best, it can have steps down or up in the interest rate charged, and that will depend on the embodied carbon performance. So if a company or a project is overachieving its embodied carbon reductions, or its target, then it might get a reduction in interest rates. If it's doing worse, it might get an increase in interest rates, for example. They're the kind of vehicles and mechanisms that can be put in place. Thanks very much.
Thank you so much, Rick. And absolutely fabulous, really interesting. I mean, it is complex, as you said. Decarbonisation, addressing embodied carbon, it does take, systems thinking, and it is definitely a team sport. So I learned a lot from yourself. So, we at MECLA, we're really keen. We're a do tank. We are about trying to sort of push the envelope and think more broadly about how we take the next steps from here. So, if you want to connect with us, please do. We've got a newsletter that will be coming out. If you've got some ideas for how we can do more in this space around innovation and collaboration, then do be in touch. Otherwise, we will bid you a fond farewell. Thank you again for participating in our spotlight, and we will be sending out all the materials from today as well. And thanks again to Rick on IGCC's behalf for your excellent leadership in this space also. Thanks all. Bye-bye.
Thanks, everyone.